Welcome back. You're still watching Markets at Noon with me, Mansi Dave and Ankur Mishra. And now let's talk about the long-term fundamentals of the market. And for the same, we have with us a market expert, Nikhil Ranka, CIO, Equity Alternatives, Nuvama Asset Management. Nikhil, thank you so much for giving your time to ET Now. It's a pleasure talking to you this afternoon. And so many positives for the domestic markets as we speak, be it the government reforms, the GST rate rationalization, the liquidity concerns which are now being addressed. So looking at all of these positives, do you think that for the Indian markets, the risk reward is now favorable and it's a good period to deploy cash at present?
So good afternoon, Mansi and Ankur, and thanks for having me on the show. So clearly, the view is that, markets are, in that sense, the economy is slowing down a bit. And therefore, the starting point of return expectations has to get reset a bit. Earlier, pre-COVID, if 13-14% earnings CAGR is what we are seeing, right now that number is probably down to 9-10%. And therefore, on an index level, 10% is something that one should expect going forward. However, having said that, my sense is we have had 1 year of correction in the markets. And we are still expecting Nifty EPS of close to 1300 for FY27, and that gives us a fair value of closer to 26,000 levels on the Nifty 10 to 12 months down the line from here. So therefore, with a 12-month horizon, my sense is this is a good time that investors start putting their money into markets. However, as I said, one should have moderate return expectations from the markets going forward.
Nikhil, hi, Ankur this side. I want to first of all ask you, were you able to watch India-Pakistan match yesterday?
Unfortunately, no, Ankur. I was occupied with something else.
So, one analogy which we can draw from market as well as that match yesterday, it was at snail's pace, comfortable win, but there was no blockbuster kind of inning or blockbuster firing or even the post-match events have also caught much of the attention. But more importantly, even for our market, if you talk about the current year, it has been at the snail's pace. And similarly, even the cricket, if you would have seen, India-Pakistan is not having that kind of excitement which it used to have because we are a better team. And similarly, if you talk about India, we are better placed than rest of the peers. And hence, I want to ask you that for the second half, when GST implementation is just a week away, do you think the second half of the earnings will be blockbuster, will be kind of a T20 mode and not the test cricket which has been going on till now?
So, Ankur, clearly Q1 and Q2 will have single-digit earnings growth for the markets. But as you have highlighted, once the GST part kicks in, there definitely will be some pickup as we get into Q3 and Q4. So my sense is for the whole year, the earnings growth should average closer to 10-11%, with second half being in double digits. The first half will likely be in single digits. Now the point, Ankur, we have to realize it, Indian markets still trade at closer to 55-60% premium to the MSCI emerging markets. Now, we were at 13-14% growth rates. Those markets were at 4-5% growth rates. So we were getting that sort of premium. Now, if our market itself slows down closer to 8-9%, then there's definitely a case that that premium can come down a bit. And that is exactly what we are starting to see in terms of FI outflows. FI is starting to feel that, if 5-6% they can make in dollar terms, because 2-3% rupee depreciation is par for the course, then the incremental alpha for them in the Indian markets is getting that much lower. And therefore, my sense is we will get a revival in FI flows once we start getting to that 12-13% earnings growth number. So for the next 3-4 months till the time we start to see earnings revival, my sense is we could trade in this broad range of 24,800 to 25,800. And then once we roll over to FY28 as FY26 gets over, that's where I think the next leg of up move should start coming in.
Explain. Nikhil, my next question to you will be looking at the current scenarios, then what are the sectors which are on your positive focus radar, the preferred ones, and what are the sectors you would advise to stay away from at present?
So Mansi, clearly I would say in terms of the sectoral preferences, given the steep GST cuts that we will see in cement from 28 to 18%, that's one sector where, even if, bulk of the pricing benefit is passed away, we will see some volume growth benefits and definitely some margin uptick should come for that sector. And we are now past the seasonally weak monsoon quarter for cement. So therefore, cement is something that we are positive on. Second sector is telecom. Clearly, we are expecting that, before the Jio IPO comes in, there will be one more round of tariff hikes that will happen for the sector. And there's almost 70% EBITDA pass through that happens in the case of telecom. So that's the second sector which is completely insulated from global uncertainties, so to say. Autos, my sense is Q3 will show very strong numbers, but we have to keep in mind that auto stocks have had a good run up in the last 2 months. Most of the stocks are up 10-12%, and therefore, post the Q3 numbers, if the volume momentum sustains, is something that we will have to watch out for as we head into Q4. If that sustains, then the rally could continue. Otherwise, my sense is auto could start taking some breather post Q3 numbers.
I also want to take
And in terms of sectors where we think stocks could stay range bound a bit, my sense is pharma clearly is one sector because there there was very high base of Revlimid for companies which had exposure to US markets, and that drug is going off patent in Jan. So there my sense is earnings could stay a bit subdued. IT also, because of AI, my sense is there could be some deflation in pricing. Volume growth will come through, but probably then the earnings growth will stay for in single digits for the foreseeable future. And therefore, although multiples are like 2 standard deviation below mean, unless we see earnings accelerating, the stocks could trade in this 5-10% band in IT sector as well.
You mentioned about consumption themes as well, and many of the investors are actually preparing for the next GST implementation, which is from September 22nd. I want to understand from you one specific sector, FMCG. What is your view on that? Because I did not see in your list, so curious to know, do you think there is still meat there for one to invest?
So Ankur, if you look at it, multiples for FMCG names in the markets are anyways elevated. Most of the stocks there are anywhere between 45 to 55 times earnings. And in the last 500 points of Nifty up move, there's 2 sectors which have performed well. Auto was one of the sectors and consumption was the other sector, where stocks have front-loaded the sort of expectations of volume growth, so to say, in my view. So therefore, my sense is Q3 numbers for both these sectors will be good. But given the way stock prices have rallied, for investors to make incrementally 10% returns in these stocks over a 6 to 9 month horizon, to me looks a bit challenging.
Nikhil, last when you connected with us, there were a few real good insightful views which you gave on the market, and in particular you did say that the tariff jitters and policy risks remain, but discounts in stocks could offer entry points. And at that point in time, you also advised the investors to be selective, favor quality names and earnings visibility. So from our medium, the investors and market participants who are watching you, what is the advice you'll give this time?
So Mansi, clearly, as I said, telecom and cement are the 2 sectors I think which could lead the next leg of move for investors should focus on these 2 sectors going forward. I think so telecom specifically is one sector where there's very high visibility of earnings over the next 6 to 12 months. My sense is one tariff hike is definitely going to come 2-3 months down the line in telecom sector. That should lead the next leg of upmove for the telecom sector. And as I said, cement, there will be a big price reduction, almost 25 to 30 rupees per bag. That should mean that, there should be some benefits which companies are able to take, and there will also be a fillip to the volume of take. So I would say cement and telecom are 2 sectors which investors could look for going forward over the next 12 months horizon.
Right, Nikhil, one more issue which was more of a nightmare earlier has now, at least we have come into terms, is tariff. We know what is the highest tariff which has been levied till now, at least till the time Mr. Trump thinks something else. And our team is going to US, there is a talk which is continuing. Do you think that the situation has kind of eased, and hence what should one's view and preparation be in terms of the sectors which are impacted by tariffs?
So Ankur, clearly at 50%, I think it's very difficult for sectors like gems and jewelry, textiles and chemicals to do business with the US, because clearly the ability of the consumer is not there to absorb a 50% price hike. Which would mean that, and if you look at the margins for most of the companies, whether be it in textiles or for chemicals, that will be somewhere in the range of 15 to 20%, the operating profit margins. Now, if consumers are passed on 25% hike, you still have 25% to be absorbed between the Indian companies and the US importer in that sense. And therefore, the margins in the chain will completely erode at these tariffs. Therefore, my base case is, somewhere closer to November end is where we should see some sort of relief coming through in terms of tariffs. The tariff should settle somewhere in the range of 17 to 20%. The final tariffs is what my view is. So if somebody is willing to take the next 2 months of pain in this sector, textile specifically, then I think it will be a very good reward that investors can expect over the next 3 to 6 months from these sectors. However, there will be volatility over the next 2 months till we have clarity. But then news and prices you will never get at the same price. So you will have to have some risk appetite and do bargain hunting in these sectors at these levels.
Right. Also, thank you so much, Mr. Nikhil, with your views, especially on the preparation which one needs to do, both on the GST news as well as the tariff announcements which are yet to be made formally. Thank you so much for your time. With this, it's time to bring